Hello everyone. In this video I'm going to walk you through the price to sales ratio to value a company, and it has couple of use cases. The first one of course is when you are kind of buying a stock of a company and you want to get a feeling of what is the intrinsic value of the company. Then the sales figure of that particular company is going to be one of the most important factor in valuing this company. So let's go over by looking at some of the examples of what the sale figure is going to, how it's going to be used to determine the valuation of the company. So let's look at some of the most important ones. I will walk you through a couple of important fields. Let's say Amazon. Amazon in the second quarter of 2020, that is the quarter that ended on the June 2020, it generated a sale of $88 billion, right? $88.8 billion. Let's round it up to $88 billion, and their sale is continuously growing over the past many quarters, and that's why it's being valued very high. Now if I assume that in the next 4 quarter it will keep growing the same, about the same rate as in the past, which may be a little difficult, but I multiply this figure by 4 to get my annual sale for the coming next 4 quarters, or maybe 4 quarters, skip the next two and then go to even next year 4 quarter. And I'm looking at what they expected. We don't go to the trailing 12 months, because the trailing 12 months, that's a history. We're not talking about that. We are talking about the more realistic future. At the minimum, we should can expect that $90 billion is going to be the average sale in the coming 4 quarters. But if we are a little more enthusiastic or optimistic or bullish about Amazon, I will say that their quarterly sale is going to be close to $100 billion. And with that figure, I put a figure of $400 billion. That's my more kind of optimistic view of Amazon. And with that figure in mind of kind of a yearly sale revenue, this company currently is valued at $1.6 trillion, which at the current stock price of 3,000, around 3,300 to 3,400. Now, personally, in my view, it's slightly overvalued, and my view could be incorrect, and the reason for that could be we are have a multiplier factor of 4 to multiply this $400 billion by $1.6 trillion. Now Amazon has two businesses. It's not a purely grocery store business. It's a technology based business, and that's why its valuation is obviously has to be higher than other grocery stores like Walmart, and I will come to that shortly, or other like Target or similar kind of businesses. It also has crowd service, which is very profitable. It also has a other AWS services, and those services are very profitable, much higher than the Amazon's sales of business, or other things like that. So, but if we give a weightage to the simply the grocery store part of it, uh, which is actually it's not simple grocery store, but it's also a technology driven platform of e-commerce where other its content is also highly valued. So that's why its value is $1.6 trillion. So I will not go into the detail of my personal view or what it is, but just to give an idea of the price to sale ratio. And in this case, we can say that at the current price, it's valued like 5 times its sales. So that's the price to sale ratio. Now come back to the Walmart that we just talked about. In the past year, it generated $532 billion of annual revenue, and there is no much year to year growth. It's pretty much constant year after year. A little, though we do see a little bit of growth, maybe a couple of percentage or so, or maybe 5% or so. Now, because there is not much high growth, and it's being rate its valuation current based upon its current stock price of $132 is $372 billion, which is much less than its annual sale revenue. Typically like 6.6 or something that you can calculate. So any grocery store which it has to generate, it has to do a lot of sale in order to generate a small amount of profit. And any sector that is generating a very small amount of profit over a very large sale will be valued less favorably than other sector that generates quite a big amount of fat profit for a small amount of sale. And that's why we will come to another company. It's a medical device company. So the medical device company or a medical drug company, they generate a huge profit because of their competitive advantage or their proprietary methods or their patents. So Pfizer PFGR, it has 49 billion dollars of annual sales, but it generates it has a market valuation of 216 billion dollars, which is roughly five times its annual sale revenue. So if you are looking at a very profitable business like Microsoft, it's a software company, and once their software starts getting sold, they have a huge amount of profit to make, and then they don't need to generate so much of sale to get a big profit. Tesla, on the other hand, is a growth big company. It's growing. Its valuation has not been completely realized, so everything is in the future. Uh, Tesla, for example, the second quarter generated $6 billion of revenue, and if I multiply it by 4, I get $24 billion. But I am making it $30 billion simply because its sale is continuing to be growing and it's going at a much faster rate. So $30 billion is, I'm not off the mark if I can expect $30 billion in, let's say, 2021 revenue. And then even then you have to multiply it by a factor over like 10, at least 10, maybe 12 or something like that, to get its current valuation of $382 billion. So in that case, the price to sale ratio is much higher. So whatever sale you are generating now, it's not based upon that. It's based upon couple or 3 or 4 years from now what it will be. That's what will generate a current its valuation. So anytime you are looking at a price to sale for a company for a valuation perspective, just keep in mind those things. Number one, a few more things. It is industry specific. The industries that are perceived to be more profitable, they will have a higher, they will command a good price for a unit sale for in that particular industry. And the two examples are medical device industry, medical drug industry, and the software industry, especially the profitable software sectors. Those are highly valuable. Even the internet based SaaS model based industries, they are perceived much better. The second thing that you need to kind of keep in mind is how the debt or a surplus cash could affect this company valuation. So what do I mean by debt? By debt, let's look at a smaller company that, let's say, generates maybe a $20 million of annual sale, and normally it's a 3 is a very slightly better than the average factor that you will usually use to evaluate for a valuation of a company. If you don't know anything, try to keep 2 as a lower and 3 as a upper end to valuation of a company. So this has a valuation of, let us say, $60 million of company. Now you also know that the company has $20 million of debt, and if has a $20 million of debt, what you are going to do that can reduce this $60 million by 20 million to come arrive at a $40 million revenue. Sometimes because company has been generating profit year after year, it has a, instead of a debt, it has a surplus cash that it keeps in for the future uses or expansion. let's say the company has $10 million of surplus cash, then its valuation will be actually be $70 million. So that's how the debt and the cash of a company affects its valuation. Future prospects: if the company's growth potential has not been completely realized, especially for the startup, and we see that the company can keep growing at a very fast rate over the next 3 or 4 years, at least those future potentials, at least partially, are accounted for in its current price, uh, in its current pricing. And finally, even though this earning, we often use price to earning as also an indicator for a company, the actual earnings are also going to play a part in this company's valuation. Uh, you often see that many companies, there are many companies, in fact, I believe most of the companies are actually generating, not generating profit, they are generating losses, but they are still valued highly, and that's why the earning is a more uncertain term. It's cyclic, it changes year to year, it changes or quarter to quarter, and it's and there could be the finance sheets could be manipulated, or it could be changed in many different ways to reflect something that we'll have to dig into details of those financial sheets. So maybe, for example, the company laid off a part of their employees and they had a one-time cost or things like that. Many of these kind of things are start playing into its earnings. If you are looking at the earnings, look for a consistency over the past many quarters and see if you can find that consistency over an old company. Then you could probably take this earning as a more definitive figure. But sales is a more definitive figure. It has less cyclical or year to year change, and it's a more definitive indicator of a company's brand name and its reach. And that's why earning is used as one of the major tools for valuing a company. uh, and I wanted to, the reason, one of the reasons created this whole thing about is that if you are an entrepreneur and if you want to start up a company, the one thing that you would, and if you eventually at some point of time you want to sell your company, so what you need to do is you need to also focus upon how you could expand to grab or retain your customer base, and you how you can increase your sale quarter after quarter, year after year, because your company's valuation will depend upon how much sale you are generating, and therefore three times that figure will be a very good figure. uh, Three times your sale could be a very good figure for that. So let's say you have a $1 million of sale. If somehow you are started a startup, and over the period of next 2 years you are able to generate 1 million sale, then you can sell this company for $3 million. So that's how this equation works for sales. And of course, if you can generate some profit and you can share the sales, it can show that your growth can be much better. You are keep growing, and instead of 3 million you could possibly sell your company for $5 to $6 million. But these valuation do not take into effect unless you cross a certain threshold. For example, if you say that your company sale is $20,000 and I can sell it for $60,000, that does not work, because then you have not created any value by, or any brand naming or anything like that. There's something like someone earning a daily wages or something, doing some job, could earn that kind of figure. It needs to be at least like couple of $1 million. So, and in a specific targeted product or service, then your company will be valuable. I hope some of this information is useful, especially for those who are investing in stock market, or those who plan to start up their business and they want to be a little bit of assured about how they are going to sell this company for a certain price. Hope that helped. Thanks.